Question 5 is the last question for this mini case. It says employees are allowed $350 for services since the last payday in January, to be paid in the first week of February. The amount to be reported in the January income statement for salaries expense is... So what they're trying to tell us here is our salaries expense account has not been updated to reflect the full amount of salaries earned by the employees. So the last time that we recorded salaries would have been the last time that we paid our employees. And when we did that, our salaries expense ended up being $6,400. So far, all the salaries that we've paid in January are $6,400. But it doesn't matter whether or not you've actually paid the salaries. If you owe the salaries, if the salaries are incurred, the expenses incurred, it needs to be recorded on the books. And we'll pay the salaries when we pay them in February, so it'll be recorded as a payable. Now, they told us that the amount of salaries that still needs to be paid out is $350, and just so you know how the journal entry would look, it would say salaries expense is increasing by $350, and salaries payable, now you could have called this wages expense and wages payable, but I just followed the language they're using in the question. So salaries payable would say $350. So with that in mind, let's fill in our T account. We're adding another $350 debit to salaries expense, bringing our total for salaries expense for the month to $67.50. And that is answer B.